Welcome back to Invest and Talk podcast. Today, we're tackling a question that, well, a lot of you have been asking us about. Is Root a good time to buy now? We'll be digging into the latest analysis, the financial reports, market sentiment, really trying to give you a clear picture of this intriguing insurtech company. So yeah, what we really want to do here is give you precisely that, a clear, unbiased look at Root. We're drawing directly from the most recent financial statements, market data. We're here to help you connect the dots, and understand the real story behind maybe some of the headlines you've seen. And before we jump in, just a quick thank you for tuning in. If you find our discussion valuable, please take a moment to subscribe, like this episode, maybe leave us a comment. Your support really does help us keep bringing you these analyses. Oh, and if there's a specific company you'd like us to look into next, just drop its name in the comments below. We always appreciate you considering buying us a coffee too. Helps keep the lights on and the insights coming. Okay, let's get into it. Let's unpack Root, starting with its core financial engine. The big question really is, what do the recent earnings and revenue numbers tell us about its fundamental health? Are we seeing a path to, sustainable growth here, or is it maybe a bit more complex?
Well, it's definitely complex. But one particularly, let's say, eye-opening data point is that for Q2 2025, Root reported total revenue of $227.3 million.
Okay.
Now, that's a solid 19% increase year over year compared to Q2 2024.
Right.
Which is definitely a positive signal on the top line. It shows they're, successfully attracting customers and growing their premium base.
Good growth then.
Yeah, good growth. However, the challenge for Root, and it's a persistent one, remains the bottom line. They still posted a net loss of $24.8 million in the quarter.
Still in the red.
Still in the red.
Yeah.
Now, the silver lining, if you will, is that this is a significant improvement from a much larger $42.5 million loss they had back in Q2 2024.
Okay, so narrowing the losses.
Exactly. And adjusted EBITDA also shows progress. It narrowed to a negative $2.5 million, down from negative $13.7 million a year ago. So this tells us they are indeed reducing operational losses, which is a crucial trend for a company in its growth phase.
So, okay, we're seeing improvement in managing losses, which is definitely encouraging. But as you said, they're not profitable yet. And the market is always looking for that break-even point, isn't it? I think they had previously targeted reaching break-even adjusted EBITDA by late 2025. Did this report give us any clarity on that specific goal?
That really is the million-dollar question, isn't it? And while they're clearly moving in the right direction, reducing those losses, there was no formal update on that specific break-even target provided in their Q2 shareholder letter this time around, which means that while the trend is positive, the ultimate destination, and maybe more importantly, the timeline for profitability remain, well, a bit of a moving target.
Right.
It keeps investors guessing, and introduces a layer of uncertainty that, frankly, larger profitable companies just don't face.
That makes perfect sense. Yeah, for a company still burning cash, having a strong balance sheet is, well, it's absolutely critical. So what's the state of their overall financial health, particularly their cash position, and how are they positioned against their competition in this very dynamic market?
Right. The balance sheet strength is the crucial next consideration. As of June 30, 2025, Root had $380 million in cash and cash equivalents.
Okay.
And interestingly, this is actually up from $312 million at the end of 2024.
Oh, okay. How'd they manage that while losing money?
Well, partly due to some follow-up capital raises. They cap the markets.
Ah, okay. Dilution then.
Potentially, yes. It shows they've been proactive in securing funds, which is, vital for extending their runway while they work towards profitability. But yeah, it comes at a cost. Long-term debt remains around $230 million, holding relatively steady. Their operating cash flow is still negative, meaning they're spending more cash than they're generating from operations.
Still burning cash.
Yeah, still burning cash, but it has improved year over year. So again, pointing to a positive trend in managing their cash burn, even if it's not eliminated yet.
Got it. And the competition?
Yeah, competition. Root's key differentiator, their claim to fame, is its proprietary telematics scoring model for underwriting.
The driving data stuff.
Exactly. Unlike traditional insurers that rely heavily on, broad demographic data like age, location, credit score, Root gathers real-time driving data, how you brake, accelerate, take corners, time of day you drive to build what they say is an ultra-personalized risk profile.
So the idea is better pricing for good drivers?
That's part of it, yeah. Potentially cheaper rates for good drivers. But it's also about trying to identify and attract a lower risk pool of customers that maybe other insurers might misprice using older methods. Theoretically, this gives Root a competitive edge on profitability. If, and it's a big if, their model is truly superior and accurately implemented in practice.
Okay, so that's their secret sauce then, using that driving data to be smarter about who they insure. But, I mean, they're not playing in an empty field, are they? Who are they really up against?
Oh, definitely not an empty field. It's a brutal battleground, to put it mildly. They go head-to-head with giants like Progressive and Allstate, companies with decades of data, massive marketing budgets, established brand recognition, the
Incumbents.
massive incumbents, yeah. Then you also have other insurtechs like Lemonade also vying for market share, often with different tech-driven approaches. Think of it this way. Root is kind of like a startup bringing a really interesting new app to market.
Okay.
But their competition basically owns the entire operating system and has been running it successfully for like a century.
Right. That paints a picture.
That's the scale of the challenge they face against these much larger, more established players. Scale, brand awareness, capital. So while Root is gaining traction, overcoming these structural disadvantages is a monumental task. It really is.
Okay, so we've kind of dissected Root's engine, right? We see it's burning less fuel, which is good, but still not running profitably. And it's up against some absolute industry titans. Now, the crucial next step for any investor is to ask, how does the market actually value this whole evolving narrative? Are these improvements making Root look like an attractive buy at its current price? Or is the market seeing something else?
Right, valuation. This is where it gets truly fascinating, I think. Root's price-to-sales ratio is currently 1.31x, and its price-to-book ratio is 2.0x. This is as of late August 2025.
Okay, PS and PB.
Exactly. And remember, since Root isn't profitable yet, traditional price-to-earnings ratios are, well, they're out the window. They don't have the E and PE.
Right, meaningless.
Meaningless.
Yeah.
So this forces us to look at these alternative metrics, like price-to-sales or price-to-book. They essentially tell us how much investors are willing to pay for each dollar of revenue or net asset value, regardless of current profitability. Now, here's the kicker. When we compare these ratios to the broader insurance sector average, which is roughly, say, 1.3 to 2.0x for price to sales and maybe 1.0 to 1.5x for price to book, Root is actually trading at or even slightly above these averages.
Wait, hang on. A company still posting significant losses is trading at or above the valuation multiples of established, profitable competitors.
That's right. It's a striking detail, isn't it?
Yeah. What does that tell us? Is the market just completely betting on the future here?
I think that's exactly it. This isn't just a number. It's a statement by the market. It tells us investors aren't just pricing Root on today's numbers or even next quarter's numbers. They're pricing it on a massive bet, really, on a future where its technology fundamentally disrupts the entire auto insurance industry.
So it's all about the story, the potential.
It seems so. It's less about the balance sheet right now and more about the narrative of innovation, that classic growth at any cost or maybe growth potential justifies the prices scenario. For investors, this means, potentially extremely high reward if that disruption happens as quickly and comprehensively as the bulls hope.
But huge risk if it doesn't.
Exactly. Equally high risk if it doesn't pan out or takes much longer. And things like traditional discounted cash flow models, they're really not practical here. You got negative free cash flow, high uncertainty, forecasting future cash flows. It's guesswork. So yeah, relative valuation suggests Root is quite richly valued compared to its profitable peers, especially considering those ongoing losses and, frankly, modest book value growth. Investors are definitely pricing in a lot of future success that is far from guaranteed.
Okay, that really helps put those valuation numbers into context. It's all about that future potential being priced in now.
So beyond the fundamentals and the valuation, which can feel a bit abstract sometimes, what are the charts telling us? What's the technical picture for Root's stock price movement? Are the signals aligning with this story of, high potential but high risk?
Yeah, let's look at the technicals. Looking at the past 6 months, Root has traded in a pretty wide range, roughly between $10 and $16.80.
Okay, decent volatility then.
Oh yeah, quite a bit of volatility, which honestly is typical for a growth company like this, especially one that's sensitive to news events like earnings reports and those capital raises we mentioned. In terms of levels, recent support seems to be forming around the $11.50 to $12 area. That's where the price has tended to find buyers and bounce up from recently.
Okay.
Conversely, resistance, where sellers tend to step in, is seen up around $15.50 to $16. It struggled to break convincingly above that level.
So kind of stuck in a range for now. Seems that way recently, yes. Now, looking at moving averages. The 50-day moving average is actually trending upward.
Okay, that's usually positive, short term.
It is, yeah. It suggests some recent buying interest and maybe some short-term momentum building. However, and this is important, it's still trading below the longer-term 200-day moving average.
Yeah, okay.
And that usually indicates that while there might be a slow recovery happening from earlier lows, the bigger, longer-term trend hasn't fully turned bullish yet. It suggests maybe a stock trying to find its footing after a pretty challenging period.
And other indicators, like RSI.
Right. The Relative Strength Index, or RSI, is currently around 54,
Yeah.
which is pretty much smack in the middle, neutral territory.
So not overbought, not oversold.
Exactly. For a stock known for its wild swings sometimes, this neutral reading isn't a strong buy or sell signal in itself. It suggests maybe a moment of equilibrium, potential calm before the next move, or maybe a period where fundamental news will be the primary driver rather than just technical extremes.
Okay, so if you put all these technical signals together, you've got the upward 50-day, but it's still below the 200-day neutral RSI. But you mentioned high volatility still. What kind of story does that paint? Is it consolidating or still kind of shaky?
I'd say it paints a picture of a stock in a bit of a holding pattern, but definitely with underlying tension. That upward 50-day, that's a positive for maybe short-term traders looking for tactical entries around news, but the fact it's lagging behind the 200-day suggests longer-term investors aren't seeing that all-clear signal yet. They're probably still cautious. The mass CD, another momentum indicator, does show a slightly positive trend. There was a mild bullish crossover observed back in August. So a small short-term positive maybe.
But the volatility.
But the implied volatility, yes, remains well above sector norms, and that reflects the impact of those news events we talked about, and just the ongoing uncertainty surrounding the company's future path to profitability. It means price swings can still be quite dramatic, which might suit speculative traders, but it adds significant risk for anyone thinking of holding long-term.
Right, makes sense.
Numbers are one thing. Charts give us a sense of investor behavior. But what about the general buzz around Root? How have recent events and the overall market sentiment actually impacted the company?
Sure.
How's being talked about out there?
Yeah, the buzz is definitely mixed, I'd say. Very mixed. So on August 6th, 2025, the Q2 earnings came out. And as we discussed, they showed those narrowed losses, which is good on the surface. However, the actual investor reaction was, well, quite divided. Despite the improvement, that continued negative cash flow really highlighted that profitability is still the key concern for the market.
So it wasn't enough to really convince everyone.
Exactly. Wasn't that definitive turning point some might have hoped for? It kind of reinforced the show me the money attitude from a lot of investors. Show us the path to profit. Then, back in July 2025, Root completed that secondary offering we touched on. They successfully raised $80 million in fresh equity.
Right.
Analysts had mixed views on this too. On one hand, great, it provided a much-needed liquidity cushion, extended their cash runway, gave them more time.
But on the other hand, it was dilutive to existing shareholders. Issuing new shares means everyone's slice of the pie gets a little smaller.
Right. Reduces ownership percentage.
Precisely. It's
Yeah.
that common trade-off.
Yeah.
More capital for the company now, but potentially a slightly smaller claim on future earnings for existing shareholders. And we haven't seen any major analyst upgrades or downgrades reported recently, suggesting kind of a wait-and-see approach from many institutions as well.
Okay, so the professionals are kind of on the sidelines. What about the everyday investor? The chatter on forums and social media, how are they reacting?
Oh, that's where it gets really polarized. Social sentiment, if you look at platforms like StockTwits or Reddit, remains quite divided, very passionate on both sides. The bulls, they point enthusiastically to the telematics leadership, the potential for this disruptive technology to fundamentally change auto insurance. They see Root as a revolutionary player, the future.
Okay, and the bears?
The bears, meanwhile, are squarely focused on those persistent profitability challenges, the ongoing cash burn, the sheer scale of the competition from the giants. It's a very polarized discussion, really reflecting the high-risk, high-reward nature of this particular investment. There's certainly no clear consensus view emerging from the retail crowd. It's love it or hate it, almost.
Gotcha. So with all these moving parts, we've got improving financials but no profit, a valuation that seems to price in a lot of hope, volatile stock action, very divided sentiment. What should investors actually be watching for now? What could realistically move the needle for Root, in both the near term and maybe looking out a bit longer?
Okay, catalysts. Short term, the big one is Q3 2025 earnings. That's expected early November. The market will be absolutely scrutinizing those numbers, looking for continued progress on loss reduction, revenue growth, and especially any commentary, any updates at all on their path to profitability.
Any hints on the timeline?
Any hints, exactly. There's also an Investor Day announced for September 2025. That could be really important. It's a chance for management to provide crucial forward guidance, maybe some operational updates, potentially giving the market a much clearer picture of their strategy in those timelines we keep talking about.
Okay. Earnings and Investor Day. Anything else short term?
Yeah, any new partnership announcements could be significant, say, with automakers integrating their tech or expansions into more states. That would demonstrate market penetration, growth, and maybe suggest their telematics model is gaining wider acceptance.
Right, showing validation. And longer term.
Longer term, the single most important catalyst is sustained, demonstrable movement towards that adjusted EBITDA break-even point, ideally by late 2025 or maybe early 2026, as they previously hinted. That's the financial turning point everyone is waiting for. It would go a long way towards proving the fundamental viability of their business model.
The proof is in the pudding, basically.
Exactly. Beyond that, you could see potential M&A activity within the broader insurtech sector impacting Root. Maybe as an acquirer if they somehow gain significant scale, or perhaps more speculatively, as a target for a larger traditional player looking to buy their technology.
Interesting thought.
And of course, regulatory changes. Anything related to telematics, data privacy, or insurance underwriting rules could either significantly benefit or seriously challenge their unique business model, depending on how things evolve. Imagine, a sudden shift in data privacy regulations. How might that immediately impact a business built on granular driving data?
That's a really great point about regulation, a potential wild card. Which leads us naturally to risk. With any investment, especially one like this, we have to consider the potential downsides. What are the key stock-specific risks and maybe the broader market risks that someone considering Root should be acutely aware of?
Yeah, let's talk hurdles and potential pitfalls. And there are several. First and foremost, Root's profitability is still unproven. That's the big flashing red light, the significant stock-specific risk. The company continues to post net losses, operating losses, and frankly, a clear, sustainable path to profitability isn't yet evident. That just creates a lot of uncertainty. Investors are betting on a future outcome that hasn't materialized.
Right. Execution risk is high.
Very high. They also face complex regulatory and compliance risks as they expand across different U.S. states. Each state has its own unique insurance regulations, its own commission. It can be costly and time-consuming to navigate all that.
Patchwork quilt of rules.
Exactly. High customer acquisition costs are another major concern. Attracting new policyholders isn't cheap, especially when you're competing against brands people have known for decades. And then there's always the risk of adverse selection.
Ah, yes. The classic insurance problem. Explain that quickly.
Sure. Adverse selection is basically the risk that your underwriting model, even a fancy tech-based one, might unintentionally attract a disproportionate number of high-risk customers. Maybe precisely because your pricing looks too attractive to them compared to what traditional insurers would charge them based on older data.
So you end up insuring the riskier drivers without realizing it initially.
Potentially, yes. If Root's telematics model, despite being proprietary, doesn't accurately identify and price all those nuanced risks, they could end up with a customer base that leads to consistently higher claims than they expected. And that could completely negate their technological edge.
Okay, those are substantial company-specific challenges. What about the broader economic and market environment? Are there external risks too?
Absolutely. On the broader market side, look, rising interest rates, increased capital costs for growth-oriented companies like Root. Makes it more expensive to fund operations, expansion, cover losses. There's also, as we've said, just intense competition from those large, well-capitalized incumbent insurance companies. They have vast resources, established customer bases.
Yeah.
They're incredibly difficult to dislodge. They won't just roll over.
They can fight back?
They can, and they are, often by adopting similar tech themselves or acquiring smaller players. And, if macroeconomic conditions were to worsen significantly.
Or a recession.
Yeah, like a recession or even just a prolonged slowdown. We could see a sector-wide revaluation, especially of high-growth, no-earnings financial or tech companies. Investors tend to become much more risk-averse in those environments, potentially penalizing companies like Root even more severely than the broader market.
Okay, that covers a lot of ground. We've gone through the fundamentals, the valuation puzzle, the market signals, potential catalysts, and now the significant risks. So after all that analysis, what's our final take on Root? Is it fundamentally a good time to buy now, or should investors maybe proceed with extreme caution?
Right, the bottom line. Based on our comprehensive analysis of all these sources, Root receives an overall rating from us of 4 out of 10.
A 4 out of 10. Okay. Why that specific rating?
What really stands out here is this dichotomy. While Root has shown genuine improvement in reducing its losses and growing revenue, the stark reality is the company remains cash flow negative, and it has yet to prove a viable, sustainable path to actually making money consistently. Plus, it's significantly exposed to both those regulatory hurdles and intense competitive risks, which are just formidable headwinds in such an established, capital-intensive industry.
So the potential is there, but the risks are very real and present.
Precisely. And the valuation, as we discussed, it just doesn't feel compelling right now for a loss-making insurer, especially when compared to established, profitable sector players. The stock appears fully valued, maybe even richly valued, particularly when you factor in the execution risks involved in achieving profitability and the ongoing potential for further dilution from future capital raises they might need.
And the technicals didn't scream by either.
No. Technically, the signals are mixed at best. While there's some evidence of stabilization, that volatility remains high, and there are no strong, clear upside indicators right now to suggest a sustained breakout is imminent.
Okay, so if the rating is a 4 out of 10, how should investors really interpret that? I mean, for a patient, long-term investor willing to tolerate very high risk, isn't there still a scenario where this could be a compelling play if they finally hit break even? What would actually need to happen for that 410 rating to jump significantly, say, to a 7 or an 8?
That's a fair question, and it really underscores the speculative nature of this investment right now. Our current assessment, based on the data, is that Root is likely not suitable for a core long-term investment holding at this specific stage, primarily given those persistent losses, the significant execution risks, and that valuation that already seems to price in a lot of future success. Now, for that rating to jump significantly, we'd need to see consistent, undeniable, accelerated progress towards profitability. Not just narrowing losses, but a clear line of sight to positive earnings. We'd need clear, verifiable evidence, maybe through loss ratios consistently outperforming peers, that their telematics model is providing a durable competitive advantage.
Proof it works better.
Proof it actually works better and translates to the bottom line. And we'd need to see a significant reduction in cash burn, ideally without completely sacrificing top-line growth. Absent those developments, it may offer short-term trading opportunities for those comfortable with high risk, maybe playing bounces around earnings or news catalysts. But the fundamental risk remains very high, and any position sizing should absolutely reflect that elevated risk. It's definitely more of a speculative play right now rather than a foundational investment for most portfolios.
So there you have it, our comprehensive look at Root, answering that key question. Is it a good time to buy now? It's clearly a complex picture. There's some definite progress, you can't deny that, but there are still significant risks and uncertainties looming on the horizon. Root's journey really does highlight the intense challenges involved in trying to disrupt massive established industries with new technology. Remember, understanding all these details, the fundamentals, the valuation nuances, the market sentiment, the technicals, and connecting those dots is really key to making informed decisions that are right for you. And maybe a provocative thought to leave you with today. Does Root's current trajectory, the struggle towards profitability against giant incumbents, suggest a future where insurtechs can truly overcome these hurdles and carve out a sustainable, profitable niche? Or is it perhaps more of a testament to the enduring power, the scale, and the deep moats of those traditional players? Something to ponder, maybe, as you consider the broader landscape of innovation and disruption in finance and insurance. Thank you so much for joining us for this discussion. We really hope it's giving you some valuable insights. We appreciate your support, so please do subscribe, like this episode, and leave us a comment. It genuinely helps our show grow. And don't forget, if there's a company you'd like us to research next, just let us know in the comments below. And we always appreciate you considering buying us a coffee too. Till next time.